Good morning. Today let us talk about the Navi Nifty 50 ETF NFO. The NFO is opening on 11 September and will close on 15 September. The scheme seeks to provide returns before expenses that correspond to the total return of the underlying index subject to tracking errors. The issue is an open-ended issue and is under the equity large cap category. Minimum investment is rupees 250 and there is no lock-in period for this NFO. The benchmark for this NFO is Nifty 50 TRI. Mr. Aditya Mulki and Mr. Ashutosh Shirvaikar are the fund managers for this IPO. The Navi Nifty 50 ETF seeks to provide returns before expenses that correspond to the total return of Nifty 50 subject to tracking errors. ETFs mimic the underlying index, which results in fewer transactions than actively managed funds that frequently buy or sell securities from their portfolio to show higher return than their benchmark. ETFs also have lower expense ratio compared to actively managed funds, which must employ highly skilled fund managers for generating active revenue, that is, returns higher than their benchmark index. The main difference between the ETFs and other type of index funds is that ETFs don't try to outperform the corresponding index but simply replicate the performance of the index. Many other fund houses have also launched their own Nifty 50 ETFs like the SBI Nifty 50 ETF, Bandhan Nifty 50 ETF, ICICI Prudential Nifty 50 ETF, Kotak Nifty 50 ETF, etc. So in such a scenario, it is difficult for Navi to stand out with a differentiated product. Investors would choose to invest in an existing ETF with a track record rather than investing in a new product.